It tells us that Mario's utility function for wealth in the face of uncertainty is given by w to the 0.5. It says that Mario's wealth is initially $400, but there's a 10% chance a hurricane will cause a loss of $300. And the first question says, what is the certainty equivalent of Mario's gamble? Well, we know when we're talking about the certainty equivalent, we're going to bring in our utility function. So the certainty equivalent raised to the 0.5 is going to be equal to the 90% chance we keep our $400 raised to the 0.5 plus the 10% chance we lose $300 and end up with $100 raised to the 0.5. We work that out and we find that our certainty equivalent is equal to 19 squared, which is 361. It says, ignoring administrative cost, how much economic value would be created if Mario were fully insured? We assume that the cost of insurance is equal to expected losses because it said ignoring administrative costs. So that's crucial to understand. Therefore, the cost of a policy is going to be equal to the expected losses, which is the initial wealth minus their expected wealth. Well, the initial wealth they gave us is 400, and their expected wealth we can solve by finding the 90% chance they have 400 plus the 10% chance they end up with 100, and that gives us an expected wealth of 370. So their expected losses in this case is 400 minus 370, or 30, which is going to be the price of the policy, or the cost of insurance to Mario, which is the same thing as the price of the policy. So remember that our initial wealth minus our certainty equivalent is the most that we would be willing to pay for insurance. In this case, our certainty equivalent was 361, and our initial wealth was 400. Therefore, the most that we'd be willing to pay for insurance, we find to be $39. So the most we'd be willing to pay for insurance to get rid of all of our risk is $39, but we only have to pay $30. Therefore, $9 is the economic value added from insurance. So make sure you understand why the certainty equivalent represents a single amount of wealth we'd be willing to trade our gamble for, the initial wealth minus the certainty equivalent, why that represents the most we'd be willing to pay for insurance.